For years, the Iranian government sold US dollars for two totally different prices, creating a system that spawned a massive, multi-billion-dollar black market. It was a flawed economic policy, originally meant to help people, but ended up creating a colossal engine of corruption for politically connected insiders. So why on earth would a country create such a system? Iran's multiple exchange rates were born from decades of crisis. After the 1979 revolution and the brutal Iran-Iraq War, the economy was in shambles. Then came wave after wave of international sanctions, which cut off Iran from the global financial system and choked its vital oil revenue. As a defense mechanism, the government created a tiered currency system. The idea was to offer US dollars at a heavily subsidized, artificially low rate. For years, this was around 42,000 riyals and later 285,000 riyals per dollar to importers of essential goods like medicine and food. The goal was noble: protect the public from soaring prices, and in theory, it was a lifeline. In practice, it split the economy in two. While a few essentials were pegged to that low official rate, everything else was subject to the free market, where the dollar's price is driven by real-world supply and demand. This created a massive gap between the official price and the street price, laying the foundation for an enormous black market. So who were the winners in this system? Any influential individual or a well-connected company could get special approval to import essential goods. This gave them the right to buy foreign currency, like US dollars, from Iran's central bank at that deeply discounted official rate. But instead of using all those dollars to import medicine or grain, they would divert a portion, or sometimes all of it, and sell them on the unregulated black market for the much higher street price. The profit was instant. For every dollar bought at an official rate, they could sell it for significantly more, making a fortune in a single transaction. The losers were pretty much everyone else. Average Iranians have watched their savings get wiped out by devastating inflation as the rial collapses on the open market. Honest businesses were punished too. Exporters who earned foreign currency were often forced to sell it back to the government at a lower intermediate rate called the NEMA rate, crushing their ability to make a profit. The whole system distorted the economy and drained Iran's precious foreign currency reserves. Years of economic bleeding caused the black market rate to skyrocket, hitting an all-time low of over 1.5 million riyals to the dollar. Faced with an economic emergency and public protests, the government finally scrapped the main preferential exchange rate in early 2026,